So we really don't know which companies are really going to grow and which ones aren't. That's akin to getting into a car with only a brake pedal. You're going to be super safe, but you may not get to where you want to go. Your taxes are your biggest expense. There's a difference between being rich and there's a difference between being wealthy. And sometimes those two run counter to each other.
Welcome back, investor. We've got another episode of Passive Income Adventures today, and this is something that I have been promising to bring you for quite some time to talk to a certified financial planner, registered investment advisor, somebody who can help you navigate private markets. So, Alan Franks, thank you so much for coming on today.
Thanks so much for having me. I'm excited.
Yeah, this is going to be a great conversation because so many of our investors or potential investors will call and we'll talk about what it is that we offer. We do mostly private lending with a little bit of private real estate equity, all real estate. We're a 506C, 3C5, meaning 80% of what we do has to be real estate. That's the designation that we chose when we set up our legal documents. So that's basically what we focus on. And then they'll say, okay, this is great information. I want to earn 10 or 12% on my money making private loans. This is great. Maybe we can buy an equity deal later this year. And they say, I'm going to go talk to my financial advisor about this, which I always want to encourage people to talk to their professionals. But then I'm like, your financial advisor is going to tell you no. They're just going to tell you no. What kind of financial advisor you have, how they're getting paid, their motivations, it's all going to really color the advice that they're giving you. So I've been saying for a while, I want to have somebody on who really specializes in private markets, which alternatives, we'll call it that. And so these are the topics that I'm really excited to discuss today because I'm not a financial advisor, but I find myself in a very awkward position sometimes saying, I can't tell you what to do. And I would love to have a group of people that I can say, but this guy, he
That's
can.
right.
Thank you for coming, Alan Briggs. Start off with introducing yourself. Give us a little bit about your background, why you're qualified to talk about this, and the things that have happened to you in your life that have led you up to where you are today.
Yeah, 100%. So once again, thanks again for having me. We were having a discussion before we started recording. It was so fire. I can't wait to do this. So a little bit about me. I'm based here in Atlanta, Georgia. My wife, Allison, and I have been married for about 10 years now. We have a 14-month-old daughter, Helen, and we've got a son coming along the way. So I'm in that really
Congratulations.
fun stage of life there. We're
Fun,
just having
fun.
a blast right now.
Yeah.
But my financial journey really started a long time ago. My dad was a first generation success. I got to watch my dad work his tail off. On the other hand, my mom actually came from a lot of family money that didn't really pass down. So I was able to see two sides here. Both great grandparents were immigrants, both came over. One worked really hard and didn't make a lot of money. One worked really hard and made a ton of money, but wasn't
Mhm.
necessarily able to pass that down through
Mhm.
multiple generations. But on the other hand, my dad really learned a hard work ethic and really started working hard in his businesses and really following what I would call alternative investments. Most business owners aren't big fans of the stock market. To be clear, I am, and I'll tell you why here later in this podcast, but I had to learn to become a
Mhm.
huge fan of the stock market. I didn't start that way. But my dad would bring me into these meetings, whether it was buying a life insurance policy or whether it was, this is back before '08, where he bought 8 rental homes at one legal sitting with no money down, right? Stuff that you don't hear about anymore, right? But obviously, big fan of Robert Kiyosaki, Rich Dad Poor Dad. And if you have a young kid, highly recommend buy the board game Cash Flow. Me
Yes.
and my brothers played it all the time growing up. We had an absolute blast playing Cash Flow, and it really taught us, hey, in order to get out of the rat race, we have to have our passive income be higher than our expenses. So if you haven't played the game, you pull a card, and that card really dictates who you are. You can be the attorney that has really high expenses. You can be the plumber who doesn't make much and has really low expenses. Everybody wanted to be the plumber. Nobody wanted to be the attorney because it would
Yeah.
take you had that passive income build up there. So that really framed a lot of my thinking. And then when I studied economics at Mercer University in Macon, I graduated in 2010 in the depths of the economic recession. Y'all, there were no jobs. I thought I was going to be jet setting for Boston Consulting Group or something. And that did not happen. I had two options. I'd be an elementary teacher in the Mississippi Delta for Teach for America, or I could go start doing financial planning. Now, here's the deal. I started doing financial planning. It's the only thing I've ever done, but I don't feel like the job was really described to me what it actually was. I thought I would be doing financial planning. Turns out I was doing commission only sales. And so I think later on this podcast, we're going to talk a little bit about
Mhm.
how do you vet a financial planner and understanding that some are commission based, some are fee based where they can do a little bit of both, right? And so when I got into this world, I'm not going to mention the company, but I was there for 5 years and I learned a ton, but I learned what I didn't want to be when I grew up, which was a commission only salesperson. So when my wife and I got married and we moved to Atlanta, I started with a new firm and really learned how to do what we call fee-based financial planning, which really allows us to take a holistic look at everybody's finances. And so what that also allows us to do is recommend stuff that we don't get compensated on. Very much like the portfolios that you're offering, Emma. I'm a big fan of those. If you have a financial advisor that's telling your clients no, I would like to
Mm.
talk to them immediately because I'm a big fan of what you guys are doing.
Yeah. Oh, this is the issue that I have to educate a lot of my investor calls is on the difference. Let's just dive into the difference between public and private markets and where the
Mhm.
term alternatives falls into this. It bugs me that real estate is considered an
Yeah.
alternative, but
Yeah.
I get it from the context that you can't own actual real estate publicly, even
Mhm.
through a REIT. That's a trust. You're investing in a company, basically. So to own real estate directly, you have to be in a private market. And so that kind of started to make more sense to me as I was learning about how to get into private markets and what the difference is and what kind of retirement account I can use to invest in private markets, what kind of advisor I want. Cause I like the stock market too. I don't want to be overexposed public or private. And so let's
Mhm.
just start in with what's the difference between the stock market, public, mutual funds, bonds, annuities, these kinds of things that anybody can buy versus private market. Let's start there.
Great. Perfect. So I want to make this really simple here. When you go into the market, there's gas and there's brakes. Okay.
Okay.
Gas and brakes. All right. Gas is going to be publicly
Mhm.
traded stock. When you buy a stock, you're buying a sliver of a company. That company is going to hire smart people who work hard to grow the value of that company. And as the value of that company grows, so does your portfolio. Now, here's the problem. Not all companies hire smart people. Not all smart people work hard. And sometimes even smart people who work hard are going to get hit by a congressional change, a tax change, shoot, a hurricane, right? There's so much that can go wrong. So we really don't know which companies are really going to grow and which ones aren't. If you look at it, it's actually almost 50-50 here. But when you're looking at it, it's the tail ends of the growth there, which right now would be the NVIDIAs of this world,
Mhm.
really drive the overall return. You just don't really know who the NVIDIAs are going to be. And you don't know when a deep seek is going to come out of nowhere and knock them down.
Yeah.
You really want to have a very well diversified portfolio, a lot of different stocks, but that's the gas of a portfolio. When we're looking at the break side, these are bonds. When you buy a bond, you're lending money to a company, and that company's going to promise to pay you back the money plus interest there. Right. And so every now and then they might go bankrupt, but generally you're going to get your money back. Right. So it helps buoy a portfolio. It helps provide income as well, but it does lower the overall returns over time. Right. So what I'm a big fan of is not so much bonds, but let's add some alternatives in here. What
Mhm.
are alternatives? It's a poor name. I don't know who named it
Yeah.
alternatives, but in general, alternatives are actually safer investments that produce income. Right.
Yeah.
So when I'm looking at, okay, what's a safe asset that produces income? I can't think of a better one than real estate, particularly when we're looking at something that will produce tax advantage income, right? Tax efficient income. That's what's going on in the public markets. On the private markets, there's a few things that we need to be aware of. A lot of times you have to be like an accredited investor, which look up the definition of that. It has an income limit. If you're married, you're single, a net worth limit there. But in the private markets, it's not publicly traded. And so it could be private equity, it could be private lending, where you're lending money to construction contractors, you're lending money to tech startups, you name it, or it can be real estate funds like y'all's. And that's, in my opinion, where I'm a bigger fan of.
Okay. So just to recap, that equities can be either public or private. Public equities are stocks. Credit, meaning lending money, can be either public or private. So in the public markets, that would be a bond, either corporate bond or government bonds fall in there
Mhm.
as well.
Yep.
And then
Mhm.
on the private side, it's loaning to some sort of a business. We loan specifically to real estate entrepreneurs, but private lending could be to any. You could buy a forklift for a warehouse guy if he needs a loan to do that. So both on public and private equities and credit.
That's right.
Okay.
And so on the private lending side, of course, we can lend out. There's some really good funds that lend to private equities. Probably talked about hard money lending
Yeah,
before,
that's
where,
basically what we do.
exactly right. So I'm a big fan of that. And that's what we're looking at when we're looking at private lending. In
Okay.
general, when we're looking at private lending, the interest rates are much better than what you would get on public lending. So meaning,
Mhm.
what bonds would pay, you're going to be getting a much better rate of return on the private side. It may not be as diversified. There might be some extra risk in there. You might have to do a little bit extra due diligence, but that's where you really want to find a good partner that you trust, like Rice Capital, to go in there and do a lot of that stuff for you.
Yeah, I find that I'm less diversified on the private side just because in the public, I just go the index, right? Like I'm
Sure.
no
Yeah.
genius on the equity side. I'm not going to beat the index. I don't even try. I don't even bother. So I just stick it in the index, set it, forget it. It's truly like passive growth for me, or maybe even passive income if it's dividend or some sort of credit bond or whatever that actually pays a dividend. I don't even bother over there. But my problem on the private side is that I can't be as diversified because one, it's who you know, right? It's
Yeah.
private. You gotta know people. I think that's where the 506c really turned things on its head because now we can advertise and actually work with people who were strangers to us, and then we developed that relationship. But before that, it literally was private. It's like a game of the rich getting richer, which it makes me angry. Like, when I think about my dad and my mom, they were very smart people,
Yeah.
and the government thought they were too stupid to figure out private investments unless they knew a
Yeah.
rich guy. It just really gets me. But I think that those things are definitely changing and the access is opening up to accredited investors, maybe someday a certified investor work in that direction. I think it's all really great. But at the same time, I feel like I'm not as diversified because it's who you know. And there's no real way to play the index in
There's
private
not.
markets.
Yeah.
Even though they tend to outperform, I think in some ways they're more risky, in some ways they're less risky. So that's maybe an interesting discussion we can get in. But let's talk about diversification in private markets. To me, it feels, and I hate to say this because I offer private investments, but it's more like buying an individual stock. You have to be much more educated and choose your pony with much more care.
You got it. And therefore, the risk is higher, and therefore, the rate of return must be higher than what the
Okay.
bonds are in order to get people to do this. Because if you were to give me $50,000 to invest, we can go out pretty immediately and put you in about 5,000 different holdings of stocks, bonds,
Mhm.
countries, all the different industries, right? However, a lot of deals like what Rice Capital does, they have minimum investments of $50,000,
Yep.
right? So when you have a minimum investment of $50,000, you can only buy and lend out on this one project here. So I always try to ladder them, right? I'm certain that you guys are coming into multiple
Yes.
deals a year, right? So
Mhm.
let's say that somebody has $1 million. I would be very weary of my client going all in on one deal just because we've had deals they do go bad, right? Hard money lending, a great example. Sometimes people don't pay their bills. Now, what's great about hard money lending is that then you can go and you can take the hard asset and resell it, maybe even make more money than you would have on the lending side. But still, that's a really scary year process there for an investor who doesn't
Mhm.
really know that, right? They don't know if they're going to get that money back.
Yeah,
Yeah,
foreclosure's not instant. If they won't give us a deed in lieu, we have to go foreclose on them, and that could take a couple of months, depending on the
yeah.
state that you're in.
It can. And for somebody who's not in the industry every single day like you, to just a passive investor there, that'd be really scary.
Mm.
So what we like to do is saying, hey, listen, they might have 10 deals this year. Let's put 50 grand. Let's try to create our own mutual fund here with
Yes.
different deals. So that's the only way I know around it. I do think, and I don't know the compliance about this, but if there was a fund where people could come in and join on multiple deals that you guys have, two things would happen. Number one, is that it would be able to add diversification immediately. Number two, there might be a bit more tax efficiency in there as well. Because right now, one of the challenges with hard money lending is that the only people that can do it are high income earners typically. One thing I do like about real estate is the tax efficiency, but some of the deals that I'm into, okay, it was make 10K, that's great, but maybe we're only in six of it, right? And so that's one thing that we do have to keep in mind when we're looking at these deals. Still not a bad deal, but we have to keep the tax ramifications in mind too.
Yes, just like we talk about having to have multiple streams of income, you have to have multiple streams of tax strategies because what we
100%.
do, we pay interest. It's not passive income, so you can't offset that with your depreciation. And unless you have some way to offset your active income with depreciation, then you're going to pay ordinary income tax on it. So this tax planning, how much of that come okay, I have more questions about what we are talking about, but maybe we should jump ship a little bit and say how much do you get into the tax planning side of things so that people are keeping more of what they make or at least having more control over where that goes with charitable contributions, things like that. Where
It
do you fall in that role?
yeah, it's the first, second, and third problem that I saw.
Okay.
right? So if we're trying to get somebody to their end goal, which is financial freedom, where we can buy time, right? That's what we're doing.
Mhm.
When we're saving and
Yes.
investing, we're buying time, we're buying freedom here, right? So if we're doing that, there's two ways that we can do that. Number one is we can increase their income over time. And
Mhm.
number two is we can decrease their expenses because what that does is that helps them get more margin so that they can send Emma more money, therefore getting more assets working for them, right? So
Mhm.
the entire time, what we're trying to do is increase margin. But when you think about your biggest expense, if you're listening to this, you think about your biggest expense, right? It could be the house that you just got at the high interest rate, at the high valuation. It could be the 5 mouths at home that you're trying to feed in this high inflationary environment, right? There's a lot of things that are, it could be travel. If you're young and single, don't own a home, it could be travel, right? Let me tell you something, you're wrong. Your expense are taxes. Your taxes are your biggest expense. So rather than we do this, we do a budgeting exercise. We look at where everybody's money is going. It's super important to know that. The more money you make, actually more important it is to own a budget, to have a budget, right? But when you look at that, all those expenses pale in comparison to taxes. So a lot of what we're doing is showing people, hey, this is how we can mitigate income taxes. This is how we can minimize capital gains taxes. And the third tax is the best problem of all to have. It's an estate planning tax, right?
Okay.
And if you look at your net worth, and you look and say, hey, if we do nothing more, but this doubles every 10 years, the chances of you having, particularly if you're working with them here, having an estate tax issue go up. And that's a great problem to have, right? So when I'm looking at, I've got a saying around the office here. So a good salesman finds a problem. A great salesman solves a problem, but the best salesman creates the problem in the first place. And I
Oh,
tell all my clients, I'm trying to create an estate tax problem for you because that's a phenomenal problem to have.
I've never heard of that third one. We're creating problems. But we talk about I've mentioned this on the show several times. I have a performance coach that I work with. When Emma's having a bad day, he gets a call, right? And he always will say something to me like, "That's a really great problem to have. That's much better than the problem you had last time we talked."
Yeah. Yeah. Hey, listen, Sam is everybody's least favorite relative. The more present he is, that means that you're doing good things.
Oh, yeah, exactly. It's like paying taxes is like the reward for being successful. And the question is like how to pay. We also have to constrain this. We're talking about income taxes. I pay a ton of taxes, sales tax, property taxes, employment taxes. Like I pay a lot of taxes. And so
Mhm.
because I'm paying all of those taxes, the federal government's let's give her a break on the income taxes. And so when we are talking about saving money on taxes, that could mean a lot of different things. Buy less stuff if you want to pay less sales tax. So, how do you save specifically on income taxes? I think it's really important to make that distinction because I don't think enough people realize like we're talking about state and federal income taxes here. And there are ways to save money on other types of taxes as well. But like you said, let's go after the biggest expense first. Like we went after our taxes first, and then we downsized our house because that was our next biggest expense. I'm like, do we really need a house that's this big? It's
Yeah.
really limiting us from being able to travel because it's too hard to rent out while we're gone. It's too expensive to maintain while we're gone. And so it just wasn't really fitting into our lifestyle. So we
Mhm.
downsized the house and then we're like, okay, what's our next biggest expense? Most people are starting out with the Starbucks side of things. Like
That's not going to do it.
Netflix is not making that big of a difference. Like it's your taxes, it's your house, it's your car, maybe travel, like you said. Let's go after those really big things and decide very intentionally where we want to spend that money. Because
Mhm.
I really do value, I hate to say travel because I hate traveling, but like having experiences and I'm willing to pay for that. But I'm
Mhm.
not willing to pay for a giant house. It's embarrassing to me sometimes when people come over to our house and they see where we live because I'm like, it's not really like rich real estate investor image I'm going for here. But at the same time, like we've really very intentionally
Mhm.
spent our money where it most matters. And the things that don't matter to us, we don't spend money there. And we just have to humble ourselves sometimes.
Totally. I want to quote my second favorite financial book. My first favorite financial book is obviously my book, Empowered Money.
Yeah.
Please check it out. But my second favorite book is The Psychology of Money. And it's so great because if somebody's driving in a nice sports car. It actually doesn't tell me if they're rich or not. It just tells me that they spent a lot of money on a sports car.
Yeah.
The image is there of this rich real estate. Hearing what other people think is very expensive, very
Yes.
expensive, right? I'm 37 years old. I'm a millennial, right? And I feel like our generation has done a little bit better job than maybe my parents' generation
Mhm.
of having to keep up with the Joneses, right? On the other, when you think about it, we still are. And a lot of
Nuance.
the times it's manifested in travel and what your latest Instagram photograph is.
Yeah.
So it may not be the washing machine because those are all the same price now, right? And maybe a car. But at the end of the day, we are still keeping up with the Joneses. A lot of it comes down to, hey, where does your kid go to daycare? Where does your kid go to school? A private school is a country club. Sometimes you're in an area where it's not a good public school and there's an actual reason for it, right? But oftentimes, even people in really good public school districts are sending their kids to private school. A country club's another example, right, of being part of something that elevates you. So we can spend a lot of money to look good, right? Or we can cut on a lot of that and go make money. There's a difference between being rich and there's a difference between being wealthy. Right?
Okay.
And sometimes those two run counter to each other.
Yeah, and having an advisor who could explain those differences to us in a way that makes sense because I just had even when we were first talking, I'm like, "Oh, CFP." I have a natural distrust of the
Sure.
CFP designation because most of us are getting this very commission heavy pushing on the that's been our experience widely with the audience, with me, with CFPs. And even when I discovered like the registered investment advisor, like, oh wow, this is but then I realized that it's the same thing. So can you explain to us the difference between what a CFP is and what an RIA is and how that changes the advice that they give or the motivations that they might have? Or is there really a difference?
No, there's a big difference, right? So when I started, I'm not going to mention the name of the company, but I started out as a commission only salesperson. And in particular, we were selling life insurance and
Mhm.
disability income insurance with maybe
Okay.
some annuities and long term care.
I like those insurances. I have those
Yep.
insurances.
They're
So for
totally fine.
it's yes, we need those things, but at the same time, it's more about the motivation. Sorry, I don't
Yeah.
wanna I don't
Yeah.
wanna
Let
make
me,
it sound like those are bad products. Why they're selling them to me. Do I really need it? Is the person educating me on why I need it the same person who's gonna make money off of me? Anyway, let's talk about all of
totally.
that.
Hey, I want to use a car analogy real quick, right?
Yeah.
If you were to go out there and interview 10 advisors, eight of them are going to fall into one of two camps, right?
Okay.
One's risk management and the other one's investment management.
Mhm.
Right? So if you go with the risk management advisor, and by the way, it's really hard to know which one you're going with.
Okay.
You go with the risk management advisor, that's akin to getting into a car with only a brake pedal. You're going to be super safe, but you may not get to where you want to go. You're going to have life insurance, disability income insurance, and annuity, long-term care insurance, right? It may be you're going to have good car insurance, home insurance, all this stuff, right? It's going to be really rock solid. Your risk management plan is going to be very fortified here, but you may not get to where you want to go because the car only has a brake pedal. On the other side, if we go and we work with an investment advisor, they don't give a crap about that. And so you're going to get into a car with only a gas pedal. You may not enjoy, who knows where you're going to end up, but you sure as heck probably aren't going to enjoy the ride, right? Because it's going to be a thrill ride on that. Whether it's an insurance risk management base or an investment based advisor, they're both selling. Just one is on commission based products and one is on investment products. And I'll tell you right now, there's a stigma around life insurance. There's huge commissions up front. And I don't want to like it. There are huge commissions up front. If you were to put that same amount of money into an investment portfolio and I charge 1%, I will make three times the amount in an investment portfolio over a 20-year
Mhm.
period than I would in an insurance policy.
Okay.
I will make about five times if you keep that for another 40 years or so. So from a business perspective to me, I'm showing up. I offer both. I offer life insurance. I offer investments. We're going to look at the pros and cons, right? But you're mentioning the word motivation. I'm going to use another word, the approach. The
Mhm.
approach to financial planning is so important because what's going on here is that the investment people are approaching it investment first, planning second. The insurance people, insurance first, planning second. They may do some planning so that they can better sell you some insurance, right? But that is where the next 2 out of 10 advisors come in, a fee based financial planner. And that is what we are. We charge an upfront fee and that allows us to evaluate everything in somebody's financial picture, not just what we make money. Because we
Okay.
still make money on investments. We still make money on insurance. You know what we don't make money on? Rise Capital Investments. But you know what? They paid me an upfront fee. They're expecting me to be a fiduciary, not just of their investments and their insurance, but a fiduciary of their entire financial picture. And that Rise Capital investment might be exactly what they need. And even though I don't make money on that,
Mhm.
they pay me a fee to give them an unbiased opinion and to be on the same side of the table and help them navigate the pros and the cons and the risk of doing this and the rewards of doing this. And so I'm a big fan of getting a fee based financial planner. Not a can't do any insurance, they can't do any of that. All of our clients ask us for insurance. All of our clients
Mhm.
want to audit their car and their home insurance every single year.
Yeah.
All of our clients want us to do a planning process and approach around their life insurance, not a sales approach. So if I'm fee only, there might be a great annuity out there that's perfect for you, but it has a commission. So I got to send it to a commission hungry person that could botch the situation. So I'm a big fan of doing fee based
Mhm.
upfront fee. It allows us to do things like spend time on cash flow management, spend time on what employee benefits you choose, spend time on great investments like what you guys offer, right? And even help out with the debt and the leverage and just overall, it's such a prettier financial picture than if we were to attack it from one of those investment centric ways.
Okay. So we're talking about more of a hybrid approach here, if I'm hearing you correctly. So we've talked about the pros and cons of fee only, commission only. Now we got the hybrid approach. Let's talk about maybe some of the downsides of a hybrid approach. It's like if you're an expert at everything, you're an expert at nothing.
Oh,
Maybe let's look at that.
yeah,
But then also tell me about from a sports analogy. We invest in some sports teams and they've got a head coach, they've got special teams, they've got the boards coach, the backs coach. I was talking to an athlete recently who's a professional bodybuilder and he has a posing coach. I'm like, "Oh, what? I'd never even heard of this before." And then he was saying that sometimes his fitness coach will give him different advice than his nutrition coach will. And so that's what the head coach is for, to make all the special teams going together. So give me that analogy with the how can you be an expert at everything? And if you're not, should we have a coaching staff of advisors? What does that look like?
great. So let's do a sports analogy here. When we bring somebody in, we tell the clients that, heck, right now we're the quarterback. And my specialization is that I'm a generalist. And
Okay.
I think there's so much power. Everybody's a specialized. It
You
takes
can
a football
be a
and
generalist.
I need to get it to the attorney. I need to pass
Yes.
it down. I need to bring in the accountant, right? I need to
Yes.
hand it off to this investment specialist, right? And so
Hmm.
there's so many different things in the world of financial planning that make a good financial planner click. This is a not a full-time job anymore. It's a full team job.
Okay.
And it's my job to know when and how to get the football to the right person there. And it's your job to ditch me if I'm not doing my job. So at the end of the day, the head coach is going to call the plays, right? But we're going to be the quarterback. We're going to get the ball to the right person at the right time, right? And when we look at that analogy there, the good financial planner, when we bring on somebody who doesn't have a financial planner, it's pretty obvious because in general, good at one or two areas. Maybe they
Yeah.
love investment, right? And that's typically what we find, right? But you know what? They never thought about their wills and their trusts. They've never thought about the HSA and their employee benefits, right? They didn't think about whether or not $1 million of term insurance is enough, right? They don't think about these things here. They don't think about real estate. They've got one really good area, right? And they think that they're a financial whiz because of that. But what a good financial plan does is it takes all of these solo acts. It takes the cash in their accounts. That's a solo act. Their investments in their 401k, they're taxable. Their insurances, right? And what it is, it takes all these solo acts that are not talking to each other. They're not communicating with each other. They're not complementing each other.
Hmm.
And we get together to create a symphony here, right? Where the sum here is bigger than the individual parts. And that's the beauty of a financial plan is getting all these parts complementing each other, not doing the same thing, doing different things here so that we can get people to where they want to go a little bit quicker, a little bit more cost efficient, and definitely more tax advantage.
Okay. Yeah, this reminds me of a story we had. We were singing in a choir and we were terrible. Like we were really bad. And I was getting really worried because I've sung in good choirs, I've sung in bad choirs, right? But this particular choir, I'm like, this is going to be a nightmare. And our choir director went out of town and had a substitute come in. Substitute. We were great. I was like, wow, this is going to be okay. We're going to perform okay. And then the next week, when our director came back in town, we were bad again. And I thought, wait a second, I'm learning something very important here. That this choir director can take the same group of people, like you said, the same solo acts, and coordinate it into something really good. And it reminded me, I grew up in a town where our football team won state champs pretty much every single year. I grew up in a very football high school. And it was year after year for decades. And the coaches would come in, the new coaches, and they'd say something like, I don't want to be the coach that starts losing state. And I think, how can they have different athletes, even different coaches, and have this winning program decade after decade? And so to me, it's more about who's conducting, who's directing, than even how good the individual players are. Is that accurate what you're describing there?
You know what? Let's 100%. I think it's about getting the most out of those individual actors. So
Mhm.
it's about getting the most out of your 401k, out of your IRA, out of your taxable account. It's about sitting down with the attorney and saying, hey, this is exactly what we want to do, or the accountant saying, this is what we're trying to accomplish here, right? Yeah, I think when you have somebody, let's get a partner on your side, not just a financial planner, but a financial partner to go through life with, to give a call. Like Emma, you mentioned a performance coach when you have a bad day. Yeah,
Yeah.
totally. I have one too. It's when we're a little spoiled right now. We're a little spoiled. And since really 2008, the economy has really grown. Stock markets have really gone up. Since a few years here, but we're really spoiled. And we got to understand that, hey, stocks don't always go up. The economies don't always grow. And so having somebody by your side that you have a really good plan for those times, be able to call them, right? That really helps.
Yeah. I love how, especially, I want to highlight this, that a generalist is a kind of specialist, because
Yeah.
we hear all the time that you should really niche down hard, be a rock star at this thing. And I'm like, I can be a rock star at being a generalist, which essentially means that I'm a good team builder. That's what being a generalist is. It's like knowing where the specialists are, how to get everybody moving in the same direction. Maybe it's because I have 6 kids and I've spent my entire life trying to line the ducklings up and get them all to go in a row. But I definitely want our listeners to recognize the difference between a very niche specialist, because our previous episode, he said, I'm brilliant at this very narrow thing. And how do you phrase it? He goes, but pretty much everything else in my life, I'm eating crayons.
I mean,
And to be a generalist, to be good at a lot of things, meaning you're good at putting teams and systems together.
100%. You mentioned, hey, what are the downfalls to a fee-based financial advisor?
Mhm,
Honestly,
mhm,
running our business is very hands-on. It's very
mhm,
time-consuming because we have to coordinate with all of this. We got to make certain that the PNC person quoting the car and the home insurance has all the information that they need and they're getting us a quote back before the next meeting. So there's a lot of logistics that go on. But let's go
mhm.
back to football here.
Yeah.
Patrick Mahomes is one of the best quarterbacks that we've ever seen. And I know he just lost, but he's still one of
Yeah.
the
That
best.
was a rough game.
You got a tough one. You got a tough one, right? Now, the truth is, though, is that at any play, Patrick Mahomes can hike the ball and he can keep it and he can become a running back and he can
Yeah.
run it, right? But is he the best running back?
Mm,
No,
mm,
he's the best quarterback. He's not the best running back. He can run it outside too and try to do what the wide receivers would do, but he would be an awful wide receiver, right? So my thing is, well, we can't be the best at everything. So we like to hand it off to the people who are the specialists. Realistically, when a good financial advisor is there to bring the ideas, to be able to
mhm,
once again spot the problem, realize his problem, get the ball to the person who can solve that problem, right? And the truth is that knowing a little bit about a lot is actually really hard.
power.
Yeah, it's so much harder. That's why, oh my gosh, if I could specialize in one thing, it'd be so easy. So easy, right? But right now, particularly the last month here, my head's been, I need to go to a chiropractor from whiplash here because of the changes that have been made here the last couple of weeks. I've got to stay abreast on all of that.
Mhm.
Life would be so much easier to be a specialist, but that's not what my clients need. My clients need somebody who knows how to find a problem and knows how to get it to the person that can solve.
Yeah, and then when we solve a bottleneck, we reveal new bottlenecks. So it's almost like you're creating new problems
Totally.
that need new
Totally.
solutions.
Yeah. Right now, we're just being transparent. We're having trouble. I love adding new clients and hearing their stories and helping people create a plan, but then we automate that plan, right? And so now we have quarterly reviews with each of our clients, but we done such a good job with automating their plan. There's really much to catch up on. Right. So I'm having growing pains like anybody where we are adding so much value that we're getting all these new clients. We're still having to service the old clients too. So
Mm.
it's a going back to full circle. It's a great problem to have. Right.
Yeah, I think somebody on this, they were talking about on the show recently, they were saying the job of sales is to break fulfillment. And the job of fulfillment is to keep up with sales. That is a great bottleneck to have in your business.
I love that. I'm stealing that. That's great.
Yes. Yes. And so you have that. Let's talk about entrepreneurship for a minute, because you essentially are an entrepreneur. So I know we don't want to get into specifics here, but explain to me the way that this license works. You have to have a broker who agrees with your investing philosophy. And because there are a lot of capital raisers in my industry who, when they first find out there's a Series 7 license and I can just go get that and raise money for a fee. And I'm like, yeah, good luck finding a broker who's going to let you raise money for multifamily equity or whatever. And it was so common. And the dream always died when they are like, oh, that's not practical. So tell me how that license works, how the broker relationship works, keeping that license active, and then how much freedom you have to be an entrepreneur, maybe on the side So tell me about compliance, essentially.
Yeah, so I went back to the way back time machine real quick and just tell you where my entrepreneurial spirit came from. My mom owned her own gym, an aerobic studio. Her dad was an entrepreneur. Her dad's dad was an entrepreneur who came over on a ship from Poland and started an iron ore company in Atlanta. On my dad's side, my dad owned multiple practices. My dad is actually a chiropractor. At one point, he owned 5 practices, and his dad owned a few gas stations, which really didn't make much money. So when I showed up and interviewed right out of college, they told me that there was no salary. I had no anticipations of a salary. I knew I'd be a business owner. I studied entrepreneurial management in college. I
Me
just didn't know
too.
what it was going to be. Now, our industry does a great job in some areas and not so great in others. Well, I'm an entrepreneur. This is my business. I file for an LLC. One day I will sell this business to somebody
Mhm.
else. That being said, every single advisor has to have a partner. And it's so important for the consumer that the advisor has a partner because that partner provides compliance oversight that helps protect the clients. Right now, there's two types of compliance oversight. One I'm a super big fan of, and the other one I'm not. So my parent company is MassMutual. Right? So MassMutual, I partner with them. They provide me tons of resources, right? And then they provide the compliance oversight. What's important on the compliance oversight is I can't recommend anything that's too far out there. We have a platform. Now it's very robust. There's nothing on there that I wish was on there that's not, right? But they do a great job of vetting everything that I can offer my clients there so that when I'm showing them something, I know it's really well vetted already. Now,
Mhm.
that type of compliance I am a fan of because we've all heard the horror stories of a financial advisor running away with money. And I'll be honest with you, maybe I'm just too dumb. I don't know how they're doing this. Like, I really don't know. I
I
feel
got
like
an episode on that too if you wanna go back and listen.
I would love to, right? Because I feel like I can't go use the restroom without asking for permission.
Yeah.
So I'm like, how are they doing this? But it happens. And even post Bernie Madoff, it still is happening, right? So
Yes.
I'm a big fan of compliance and regulation right there because without trust, our industry can really go down quickly. Right? Unfortunately, it's still happening every now and then, but the amount of times it's happened has really cut down. And so when I tell people my parent company is Mass Mutual, oftentimes they've heard of that name,
Mhm.
they trust that name, and I use that as a strength there, and I really appreciate that part of the compliance. The part I don't appreciate is I have a lot of work. I have this artistic urge in me, this itch to go up there and create, right? And create good content and to really add value to people's lives there, right? And really tight on what we can say publicly and stuff.
Mhm.
But one thing that they allow me to do is go out there and write my own book and basically create my own company with that book. So I'm here today, not necessarily as a financial advisor. I'm here as an author of Empowered Money because that way I can do it as an outside business activity and be a little bit more liberal with what I can say.
Mhm.
They're promoting the book, not my financial point.
Yes. That's what's I may be a doctor, but I'm not your doctor.
And that's a great as I am a financial I'm not an accountant, I'm not an attorney, I am a financial advisor, but I'm not your financial advisor.
Hey, yeah,
Just
I
start
do
off
the
with
same
that.
thing. I'm not a financial advisor. I have no licensures. And I'm just telling you what's worked for me, stories I've heard from our investors. These are just ideas to go and discuss with your financial planner. No, a
Good.
financial planner who is holistic. And that was one word when we first made contact. It's you're a holistic financial planner. And that really appealed to me because somebody got to be conducting the orchestra here. Okay.
Well, and what a good financial advisor does is that they can help your clients find the money that's needed to invest in
Hmm.
projects.
Yeah. Tell us more about that because I don't know if this is related or not, but a lot of my friends who are financial planners are broke. Like, they're not doing a very good job with their own family finances, and
Good.
their clients would never know that, but because I'm friends with them, like, I see what's going on, and I
Mhm.
hear them telling me issues that they are having financially, and it's mind-boggling to me that they can't find more of their own money to be able to invest, either by controlling their own personal finance expenses or being able to get at some of the resources that you're talking about so that they can be wealthy, giving advice to other wealthy people and hopefully, maybe they're so wealthy that they're working because they want to, not because they have to. That's the kind of advisor I want. So talk to me about walking your own talk at the same time you're talking about freeing up money to be able to have more to invest.
Yeah, and you have a few friends, and I've got an office with 100 colleagues behind me, and I know a lot about their finances. What you're saying is so accurate. Now, a couple of things that I do want to have a disclaimer to. One of the reasons that financial advisors can get into financial problems is that being a financial advisor is actually very hard to do. And so it
Mm,
might be a revenue issue where they're just not making the money that they need. So they're falling behind in certain areas.
mhm.
The other issue though is that financial advisors we talk about or salespeople, and salespeople inherently are awful at saving money because they always feel that they can sell their way out of any problem that they create.
Yes.
I don't like to recommend anything. I'm not doing it as well.
Mhm.
So anything that I recommend my clients, something that I've either already done or I would do, or I would recommend my father and father-in-law do. If I'm advising somebody who's 60, they're going to have different needs than me. So maybe I'm not doing that specific product, but it'd be something that I would recommend to my father and father-in-law. Now,
Mhm.
we haven't talked about this much, but I own 6 rental homes. Big fan of passive income. I will say this. I think I'm about residential home now, right?
Yeah. Oh, you can only have a few before it's another full-time
Wow.
business. I think about 10 units. I think I had about 6 or 7 properties with
Mhm.
10 units that we owned by ourselves with no partners. And then I started buying apartment buildings. I bought about 3 or 4 of those, and I was like, "I'm running an asset management, property management business here. This was not the plan." So, yes, I hear you.
Exactly, right? So, we still own I've never sold a house. I just house hacked my way through a couple
Mhm.
complexes, right? And so then all of a sudden I realized, "Oh my gosh, I don't have to be a business owner and worry about plumbing. I can be an investor." And that's powerful right there, right? So when you look at how much Warren Buffett made off of Coca-Cola versus what the CEO of Coca-Cola made, right? CEO of Coca-Cola sacrificed 60 to 80 hours a week to build Coca-Cola and run it, right?
That
Or to
is
run
such a
Coca-Cola.
good analogy.
Warren Buffett did not, and he made a lot more off of
My
Coca-Cola than
investors
me.
all make more than me.
Exactly.
Yeah.
So when I'm looking at this, I'm at a stage of life. In the last 10 years, I had a ton of time. I did. My financial practice wasn't quite booming yet. We haven't hit, right? Going, watching an Airbnb in town Atlanta was so much fun. We get these words on Airbnb, it's just ching to ching, right? It takes just a few guests for all of a sudden that to wear off, right? And
Yep,
now all of a sudden,
that they're
we've got
annoying.
1 kid with 1 kid on the way here.
Mhm.
Any time I'm spending on that real estate, it's actually taking away from my main business, which is a lot more profitable than the real estate, right? So I love real estate. I do. That being said, I think I'm about personal real estate out here. And so what I do with my personal money, because I tell you what to do, but what I do with my personal money is I'm a big fan of something called a line of credit. There's 3 lines of credit. Let's talk about the first one here. One is a home equity line of credit. A lot of people have equity in their homes right now based off of the surge in real estate prices over the last 5 years. I want to be clear. Your equity in your home is pulling what we call a Blutarski. All right. Blutarski is a character from Animal House who had a GPA of 0.00. That is what your home equity is doing. It's worse than your savings account. It's worse than even your checking account, right? Your equity in your home is doing 0.00% rate of return. We say, oh, how could that be? My
I
home
pay
is,
money to live here.
yeah, exactly. And so my home value has increased so much. No, I'm not talking about your home value. I'm talking about the equity in your home is sitting there and it's not doing anything for you. So the first thing I typically recommend is to get a home equity line of credit and to do it as an emergency fund first. Okay.
Mhm.
Good. Because liquidity equals security, right? And if we have liquidity, if we have $250,000 of liquidity there that we can access at a really advantageous interest rate, maybe that means I can keep less money in cash. Maybe that means I can invest more money, right? Maybe that means my investments can be a little bit more aggressive because I know I'm never going to have to touch those investments when the market. I can first pull from my checking, my savings, and then a $250,000 home equity line of credit before I ever have to go sell and
Mhm.
invest, right? Because the only risk we have on investments is realizing losses, selling when the markets are down. Happens about 20% of the time. Once every 5 years, we typically have a correction. Been a little bit longer here recently, but we have that emergency fund of a HELOC. It's going to allow us to keep less money in cash, invest more of it, be more aggressive with those investments. So from an emergency fund, a HELOC is super important.
Mhm.
Well, an opportunity fund, this is where it gets fun because all of a sudden, oh my goodness, I have $250,000 available to me. It's earning me nothing. If I borrow from it, I have to pay, it's called 7.5% right now, right? But Emma's telling me that she can get X amount of percent, right? So if I can get, let's just easy math here. If I can borrow at 7 and go get 14, I'm netting 7%. So all of a sudden, the equity in my home now is earning me 7%
Mhm.
inadvertently earning me 7% here. And so now all of a sudden we can get those dollars working. So that's one line of credit I would recommend everybody get just from the security standpoint.
Mhm.
And let's take that same concept. And now all of a sudden, let's talk about a securities-backed line of credit, a line of credit on your investment. Every single one of my clients has a line of credit on their taxable investments. Can't do it on your IRA, your 401ks, but your taxable investment. Because I'm a big believer that most people A, don't save any money, they just spend it. B, the ones that do, oftentimes they invest and they invest a dollar and they get a dollar working for them. And that's phenomenal, right? Because that dollar, if it earns 7%, rule of 72, it's going to double every 10 years, right? So a dollar will become two, will become four, will become eight, right? Over a 30-year period of time. And I love that about the markets. It doesn't, there's no plumbers. You don't have to worry about anything. It just, it's thing, right? But wealthy people, what wealthy people do is they invest their money and they get a line of credit against their investment. And then they go and they borrow what's called 50 cents on the dollar. And they go give it to people like Emma to go do real estate with, right? So now all of a sudden, we don't have a dollar working for us. We have a dollar 50 working for us, right? And that's how wealthy people do it. So I don't know how Beyonce bought their LA home, but when I saw an article saying Beyonce buys $50 million home in all cash, I'm like, no, she didn't. She probably borrowed from her investments because her
Yeah.
investments are really kicking it right now. And it'll earn a lot better rate of return than whatever the mortgage interest rate would have been. It's probably borrowed from there. So perceivingly, she bought it in cash.
Mhm.
Realistically, just maybe borrowed. I'm not her financial advisor. Like I'd love to be, but I'm
Yeah.
not. But that's my guess of how she did it. So wealthy people will invest a dollar, have an investment line of credit, securities of credit. When they see an opportunity that they really want to seize, they'll go get it.
Yeah, we did something similar, like, we paid cash for our truck and our RV, but we just borrowed money from our life insurance policy, so it's did we really pay cash for it? But the seller, it felt like cash to him, so we got a better price.
Hey, so let's talk about life insurance real quick because people don't
Mhm.
talk about it because it's voodoo to talk about it, right?
Yeah.
Okay, so when we talk about life, that's the third line of credit I have. All right, to get full story here, right? I do what I practice, preach, right? So I'm
Mhm.
investing money in the stock market, I'm borrowing against it to do hard money lending stuff. We borrowed against our life insurance policy to participate in a 130 unit apartment building, right? So I went from being a business owner to being an investor in this stuff, and that's what I've said. But that life insurance loan is actually the best loan I've the best interest rate. It's at 5.5, right? My HELOC's at 7.5. My investment line of credit's at 8. My life insurance is at 5.5. You know what's great about that life insurance? I don't have to pay the interest on it. The interest capitalizes. So I
I
don't have to
pay it when I
pay it.
feel like paying it, which is never.
Yeah, exactly. I'll pay it when the apartment building I'm invested in comes in and pays me back. I'll repay it then and I'll get caught
Mhm.
right back up. But life insurance can get a bad rap because of the commission breath
Yes.
that we talked about earlier. In my opinion, is the approach to selling it. We have two camps here. One camp is, my gosh, life insurance is amazing. It's almost a miracle product. Put all of your money into it and then borrow against it and all of this stuff. And then you have the other camp that's, don't do that. It's the worst thing ever. And the truth is, it's not the
Somewhere in
worst
between.
not a miracle product. It is
Exactly.
a good product for the right person. It's
Yeah.
about how does it fit into an overall financial picture? Because I have life insurance. I have a lot of it. I do. But I also have investments. I also have real estate. I also have a lot of different asset classes here, blend and mold together nicely. So the problem with life insurance is that it's being oversold. It's that when people come to you, they're
Mhm.
but by the way, it's called Section 7702 of the tax code. Look it up. It's a very tax advantage way to save money here. And there's multiple ways we can do it. We do a safer approach. Some of us have a bond portfolio. We can invest it in the markets. If you're in a high income tax, we talk about income tax. Let's talk about capital gains just for a second.
Mhm.
People think capital gains taxes are 15%. No, they're not. They're 15% if you make less than 600 grand. But then if you make more than 250, you have a 3.8 affordable care surcharge on there. And then whatever your state taxes are, add on there. So, if you're in Georgia making 250 grand a year, you're paying about 25% capital gains taxes. If you're making $600,000 a year, you're going to be paying about 30% capital gains taxes. So finding a way to have your money grow tax deferred is a huge deal right here. And that's where life insurance can really come in, is showing you that section 7702, where the growth in there is tax.
Okay. Yes, and judgment proof.
Yes.
Because people might sue me. I own properties where people could slip and fall. So
That's
I try to run everything through the insurance policy and almost like a holding account or sweep account. So we'll pay off that loan, having money sit there. We have a
Mhm.
certain amount we leave in there. Let's talk about risk here because you talked
Yep.
about the emergency fund, which we have a certain amount in our HELOC that we never
Totally.
touch unless it's a legit like hair is on fire, right?
Yep.
The same thing with our life insurance. There's a certain amount that we just leave in there because the HELOC I can get at in 5 minutes. The life insurance I have to go get a loan. It takes a little bit longer. So we leave
Totally.
some here, some in cash, some in a life insurance policy. We have little emergency funds scattered around. We cannot invest the entire thing. We have to think about risk
Yep.
management. So let's
You
talk
do.
about the home equity line of credit. There's a risk there to doing that. One, are you sentimentally attached to your home? Do your children really go to that school and in that community? And if you lost that home, how big of a deal would that be for your family? There's a certain amount of risk here. When we're doing a hard money loan, we could borrow from our business line of credit to
Mhm.
fund that loan. And then we could actually pay our investors more, but that increases the risk on our part that we could go belly up. The more risk lending risk we take on with leverage returns. So if we are going to borrow against a business line of credit, we would have to disclose that in every loan. So we have a customizable fund. So some loans have these terms, some loans have those terms. So if we wanted to do that, we would need to convey to be compliant the increased amount of risk that we're taking on by borrowing money that we're loaning out and then the investors coming in to fund the rest of it. So all of these things come with a risk reward. You also mentioned early in the show that private markets tend to be safer than public markets, but yet at the same time, they can be riskier because of various reasons. So let's talk about balancing the risk of making these decisions. Because, like you said, people find out, oh, life insurance, it's a miracle product. And then they actually go try to deploy and they're like, okay, this maybe isn't as wonderful as my sales guy told me it was because there are certain downsides. So let's talk about the downside of risk of borrowing against your home, borrowing against your margins. Is that what you mean by securities-backed line of credit? Or tell
Sure.
me about
Yeah.
that.
S Great points here, right? Whenever you're investing, whether it's private or public here, once you get public, you're gonna have a lot more diversification there, so
Mhm.
it can really mitigate the risk. Private, you're not, right? So you really gotta think long and hard and not invest any amount of money in any one fund that you wanna be able to lose it. Now, when I'm looking at this, some of the times you're betting on the person. Some of the times you're betting on a person and their group and their research. That's
Mhm.
about all you're betting on, right? Because I'm certain Rise Capital has beautiful pamphlets that tell you how wonderful of an
Yeah,
investment's going to
I'm the
be, right?
graphic designer. They're very beautiful.
Exactly,
Partner
exactly.
who runs the investments itself.
Exactly right. And I tell all my clients when they're looking at this, I want to let you know it's all window dressing. They're doing their best job to estimate. Nobody knows. Right? Nobody
Mhm.
knows yet. What's again? It could be a hurricane. Who knows? So when we are looking at borrowing against our assets to go invest in something else, I think I've got two rules for me personally.
Okay.
Number one, it has to be very safe. And number two, it's got to produce an income stream so I can pay off the loan. Right.
Yeah, because the
Now,
loan will have a payment now that you have to
well,
also factor
yeah,
in.
you got it. So I've got a lot of lines of credit out there. My interest payments right now, which is why I like the life insurance because I don't have to make that one. It just capitalizes. But the other lines of credit, my HELOCs, my investment lines of credit,
Monthly
yeah,
payment.
no, I have to pay interest every single month. So that's definitely a risk. And that's why we've had clients borrow against their HELOCs, redo their basement, and they got a great basement, but now $500 a month payment each.
Yeah.
Yeah. So I don't like to borrow against money for stuff like that. I like to borrow against money for something very safe, i.e., typically real estate falls into that category. And number two, produces an income stream. So that's why
Mhm.
I don't want to borrow. Trading on margin would be borrowing against your stocks to go buy others.
Okay.
That to me is very scary.
Okay.
Yeah.
So you're talking about something different with securities-backed lock than
No.
mark. What is that? I've never actually heard that term before.
Yeah. Okay. So a securities backed line of credit is the same thing as a HELOC. It's just using your securities as the collateral on the
Mhm.
line of right. So I actually think it's a little bit better than a HELOC. Let me tell you why. Number
Mhm.
one, it's free and it's all online. If you ever get a HELOC, my God, it's just
Brain damage.
awful, right?
It's not a Freddie commercial loan. It's pretty bad.
Yeah, exactly, right? Getting a home equity line of credit, I warn all my clients, like, hey, it's worth it. Go do it. I just want to warn you, this is a month-long process here. It's gonna cost a little bit upfront to get access to that
Mhm.
capital. Still worth doing, right? But a securities-backed line of credit takes a week or two to get, totally free. It increases as the value increases on there, so that also means it decreases as the value decreases. We gotta be careful
Mhm.
not to over leverage it. But what it does, same thing for a home equity line of credit. Number one, it's a security. blanket. What do I mean by that? Hey, it's here because if you ever need money and the markets are down, we can just borrow against our funds rather than having to go and sell stock, right? So, in my opinion, getting a securities-backed line of credit, once again, first and foremost, it's a security blanket. Second of all, though, it's an opportunity fund. If I can borrow at 7% and go get 17, I can do that at some extra return on that investment, right? And
Mhm.
so that's what a securities backed line of credit is. I recommend all my clients who have taxable investment accounts get those. First and foremost as a security blanket. Second of all, when you have access to capital, deals tend to find you.
Yep.
And these deals can be really helpful in wealth acceleration.
Yes. The money follows the money. The deals follow the money. Everything follows the money. To follow the money, right? That's one thing that I switched from acquiring rental properties and acquiring apartment buildings was everybody wanted to bring me into a deal if I could raise capital. And I'm like, "No, I can't raise capital. I actually want you to come raise capital for me because I'm not very good at it." And so I said, "I can't find anybody who's gonna do this. I'm just gonna have to do it myself. I have to become a specialist." I was a generalist. And I said, "I'm gonna have to specialize in raising capital because that is the biggest bottleneck in this business." And I noticed almost immediately when I hung out my little capital raising shingle, I still couldn't raise any money, but this is what I'm doing now. Just deals started flowing in, and most of them were vetted. At least most of them were at least base hits. And I could be so picky, I'm looking for home runs instead of just something that'll pencil when I was buying it. So it makes a big difference if you have money and you can get at money, whether you're a capital raiser like me, or you just can get at your own money. Like deals, like it becomes annoying. Think about that rich guy who's always getting pitched at parties. He can be very picky.
Hey, one thing I want to talk to you a little bit about, going back to the investment line of credit, is this idea of what's safer, right? So I
Mhm.
want to talk to you from my economics days, the concept of opportunity cost, right?
Yes.
We put money over here in real estate. We can't put money over here in the market, right?
Yeah.
Now, which one's going to outperform over time? I don't know. They both did really well the last 5 years, right? Now real estate's having a little bit of a tough path, at least where I'm at, but stocks have still gone up. Right?
I
So the idea here is that opportunity cost. If we do this, we can't go do this. What the line of credit allows us to do is eliminate some of that opportunity cost. Because what the line of credit allows us to do is go invest our money in the stock market and then also borrow to go get into the investment. Now, I
okay.
realize on the surface, that seems a little bit risky. The market is pretty steady. It tends to double every 10 years. So let's say that we lose money on a real estate investment. Okay. At least our money was still invested in the market. It has doubled. So if we had, let's easy math here, $1 million, we could have put $500,000 real estate, $500,000 into investment. Okay. Let's say extreme here, we lose $500,000 on the real estate side. Guess what? At least our money was still invested and we made $500,000 over the next 10 years to cover it. Right. So at least if a deal goes bad, we didn't also have the opportunity cost. We'll just have the cost of that investment, but we won't have the opportunity cost of what we could have lost as well.
Okay. Yeah, that's a good way to look at it because there are pros and cons, trade-offs, but you're talking about it's almost like a reverse trade-off, being able to double dip. As long as we are aware of and can manage the risk, and we've made sure we've chosen the correct investment that will actually pay for the loan itself. Yeah, it could be part of a diversified portfolio. And I don't think a lot of people realize how much access to capital they have. They just have to decide their own risk level,
It's
where
not
to
for
manage it.
everybody. I've certainly scared some people off just talking about a home equity line of credit as an emergency fund, not even talking about it as an opportunity fund.
And they're
Oh
like, "Oh,
no, we can't.
no."
Oh no, it's safer to have it than not have it. And so you're right. We have to meet everybody where we're at. So when you're a
Mhm.
financial advisor, today I want to be talking to an old person and then a young person, a right winger and then a left winger. We're offering a buffet. You don't have to eat it all, right?
Yeah.
We're just
Yes.
offering it to you. I think our clients appreciate that because at the end of the day, we're not the heroes of their story, they are. We're just here to try to help them along the journey.
Yes, exactly. And just being able to offer options and being able to talk about options, whether you're getting a commission or not, because it's different when I know what you're getting paid for. I know what you're not getting paid for. I know in that case, it's just, I don't know. It's just transparency and disclosure. Honestly, it's like just the same thing that I said. If we're going to borrow money, which we have never done, but if we were to do that, we would definitely disclose that we're borrowing money to go and lend on this thing because that changes the risk balance. As long as we're talking about it, we're open upfront. Just make sure that whoever you're investing with, whoever is advising you, transparency and those deeper motivations are really important. to understand where they're coming from. Is there a conflict of interest that's in fine print at the bottom? I had a lawyer one time tell me I was talking about a potential conflict that I wanted to figure out where in the marketing stream this which should have come in. It was somebody I was considering investing with. And he said, "That's what the PPM is for." I said, Really? You want them to bury that in the PPM and fine print?" And I said, I didn't hire him as an attorney after that. Cause to me, it's that kind of attitude. It tells you something about the integrity and the motivations of the person that you work with and the kinds of justifications they make for trying to make things more opaque or harder to get at or,
Yeah.
yeah,
It's hard to imagine this. When you make a career out of this, there's going to be deals that underperform. There's going to be deals that
yes,
overperform. There's going to be deals that underperform.
former is
And
right.
what's
The
that?
100% of pro formers are wrong. They're either too
Yeah,
high or too low.
exactly. Right. So I think that investors at least need to understand that. And they just need to know that, hey, when they need to talk to you, you're going to answer the phone. Right. And get back and give them an honest answer. I think that's what people are really looking for. They're not looking for 100% hit rate on this. They're looking for integrity on there. Obviously, the capability to do this, but maybe even more importantly than the capability is the integrity to say, hey, you know what? This is where we went wrong. This is what we're doing to fix it. It may not be the rate of return that we promised you. It's still going to be decent, not as good as we thought, right? But we won't make this mistake again. And I think that goes a long way when retaining clients and getting them to go in on the next deals as well,
Mhm.
right? 'Cause it's not all sunshine. Hey, life's not linear. Neither is wealth building. There will be dips in this. And we just gotta understand and not freak out during those dips.
Yeah, I think that has calmed me down a lot and actually increased my risk tolerance to be able to say, "I will lose money sometimes, and it's okay because I'm gonna make a lot more than I ever lost," and helps me just to stay sane and stay in the game because the biggest opportunity cost is not playing.
Yeah, and you know what? It's highlighted in a private market because we don't have a diversification. If you were to go look at the S&P 500, it's pretty amazing. About half the stocks make money, half of them lose money over time. But once
Yeah.
again, it's the ones that are making money on the top tail end
Yeah.
really driving the return. So you look at an ETF and it's steadily earning you 7, 9, 10%. If you were to
Yeah.
dive into there, you're going to have winners, half losers on there. Luckily, I think in the private market, you're going to be batting a lot better than 50% on this. But that being said, 50% of the deals are going to outperform, 50% of them are going to underperform. But what I do like about what you guys do is very rarely is there a huge risk to losing all your money. It's just really a risk of, hey, will this perform the way that we think?
Yes, and that is one thing I don't know. Just be where are you on the capital stack? Are you the first lien lender? Are you the second lien lender? Are you preferred equity? Are you common equity? Are you general partner equity? Because general partners get paid last, first lien lenders get paid first. And so that's one way that you can also evaluate the risk of an investment that you're considering making, especially if you're going to borrow money to do it. Like, how safe is it? So it's maybe a little risky to borrow against over here, so it needs to be extra super safe over here. And having a variety of those all the way through the capital stack, I have investments from first lien all the way up through preferred equity, all the way up to general manager or general partner equity. And I get paid last on general partner and I get paid first on here. So that capital stack is really an important aspect of understanding risk on both ends because when you borrow against your HELOC, now there's a first lien lender who gets his money first if something goes wrong on your side. So that's a concept I don't know, that we discuss enough in evaluating risk.
Yeah, absolutely. And in general, going back to stocks versus bonds, gas versus brakes, whenever you're lending money, it's going to be a little bit safer than if you were participating in the equity part of the deal there. So I love it. You're basically describing it as well diversified portfolio.
Yeah, shocker. That concept is I think some people lose their ability to diversify when they get into private markets. They lose their heads sometimes, start chasing
They do.
yield.
They
So their private has even more diversification options than public, and so it
totally.
should be a strength of private. I
I
know.
think right now, I have no clue what's going to happen. I have no clue what's going to happen this afternoon, honestly, let alone the rest of this year or the rest of the next 4 years here. But I think people are a little bit on bubble alert, right? People are a little bit on bubble watch right now.
Yeah.
My biggest thing is I am scared of inflation. I am because
Oh,
I've seen what it's done to my clients' budgets. We're talking about what are the most biggest parts of a budget, right? Besides what we talked about, food has gone up. I actually went on NBC yesterday to talk about Valentine's Day and the cost of eating out and how
mhm.
expensive it is, right? And I've seen my clients' food budgets go from 2 grand a month to 4 to 5 grand a month. And they're really not changing their habits. It's just, hey, but they're not adapting either, right? We've got
Mhm.
to understand that, hey, restaurants are at this intersection of inflation where we have food costs soaring, we have transportation costs, wage pressures are going up, the pressure to tip more is going up, right? And so when we look at it, eating out is probably about 3, 4 times more expensive than cooking the same meal in, right? And I'm concerned because typically inflation comes in 2 waves. If you look back at the late 70s, early 80s, Jimmy Carter era, we had 2 waves of inflation. The first wave, a lot of people survived. A lot of businesses survived. What happens is we thought that we had inflation suffocated and we got aggressive again, and inflation came roaring back, right? And that's when businesses went under because they had already exhausted a lot of their reserves. People go bankrupt, right? So I think that's the biggest thing. But knowing that, what do we do? Knowing that, I think that we need to understand that the worst place to have money when inflation is going on is cash, right? Cash is the one thing that really gets eaten away. When we look at, okay, what's inflationary resistant? Stocks, real estate, two really great asset classes to be in. They're inflationary resistant right there. So that's my biggest fear right now. That's what I'm looking at. Who knows
Mhm.
what happened? I could be totally wrong. Been wrong before. But that being said, it's about doing the normal thing in times of chaos that really adds up over the long haul, right? So if we need to do the normal thing, which is okay, let's continue to fight our battle. Let's save, let's invest, diversified stock portfolio, and private real estate investments, right? We can just keep on doing that in this midst of the chaos that's going on us around us. We're going to be fine.
Yes, it's the eating an elephant. It's shaving hair. Like I said, multiple streams of income require multiple strategies. Saving money on taxes requires multiple strategies. I know that sometimes this can get up in the details and sound very complicated, and all this people's heads are probably exploding as they're listening to this. I know I've learned some new stuff today as well, like security-backed line of credit. And so just understanding that it's little pieces, little tiny shaves here, little tiny shaves there across an entire spectrum of a portfolio or personal finance philosophy, that's what adds up to really great results. Like you said, it's doing the boring stuff over and over and over again over time that's really going to yield us, frankly, the mediocre results that we're going for. And I hate saying that we're
Yeah.
striving for mediocrity here, but really that is what we're going for. Your crypto meme coin is not going to the moon. So let's just focus on what wealthy people do, which is boring stuff
Yeah.
consistently over time.
Hey, wealth building, when done correctly, is very boring. Right? And
Yeah,
so we use a
totally.
software to help our clients track their wealth building. One of my favorite reports right now is looking back the last 3, 4, 5, 7 years that we've been working together and showing them their progress, right? Because otherwise they feel broke. They feel like we haven't made any progress. I'm like,
Yes.
no, we started working. Your net worth was at 300,000. Now it's at 1.3 million, right? That's only five
Yes.
years, right? So it's so important. And that's in any area of life to look words, right? There's a great book out there called The Gap versus the Gain. And we always
Mhm.
focus on where we want to be opposed to where we are. We need to take a break and not do that. We need to look at where we were and how far we've come, right? Because that's going to give us that motivation to really go forward on it.
Yes, this is something we a couple of years ago, my entire family, my kids, we went and hiked the Arizona Trail, 800 miles, Mexico to Utah border.
Wow. That's
And one of the biggest things I learned about life on that trail, because hiking is like the ultimate life analogy. Every time when we were hiking, we were only looking at our feet because it was rocky. And if we didn't look at our feet, we fell down a lot because we're trying to enjoy the view and all of this kind of stuff. And then we started falling and injuring ourselves. And we realized you really have to look at your feet. If you want to look at where you're going, you have to stop. And if you want to look at how far you come and appreciate the progress, you have to stop and turn around. And so you're never going to be making forward progress if you're looking ahead of you or even looking behind you to appreciate where you've come from. You really do have to take a moment, turn around and be like, wow, look how far we hiked today. Those moments are very important. But we have to remember that when we're making forward progress, we're just staring at our feet. It's pretty boring one step at a time.
yeah, it's step by step, right? Step by step. And here's the challenge that I have as a financial advisor is that our world right now is a very quick world, instant gratification, hot take world
Mhm.
but we see this clip on Instagram, and next thing you know, we want to go buy a rental home and manage it more than X amount of hours and do a bonus depreciation so that we can have as an active income stream so that we can pass on those losses to our W 2. And you look, you watch this quick video and you're like, oh my gosh, yes, we need to go do that. Right? What's not telling us the whole picture, is it? Right?
Mm-mm.
There's a lot more to this story, right? So what we're finding is that in this world of specialization and hot takes here, is that everybody that wants to be all in real estate or all in life insurance or all this, all that. And I can't think of a worse way to build a financial plan, right? There's a way that we can do all of this in a way that really complements each other. So that's one of the challenges I face in this
Mhm.
specialized hot take Instagram world here, where everybody has TikTok financial advisors. And so getting them in here and saying, hey, I do like it because it gives them ideas and then they come to me and ask, which I do appreciate. But people get just a little bit too narrowly focused on this thing because it's easier to do that and be a real estate bro or a crypto bro than actually have a good financial plan that has a lot of different tentacles in a lot of different areas.
Yeah, if your financial plan is sexy, you're doing it wrong. So we're gonna make some YouTube shorts off of this content, and somebody's gonna watch Alan saying some quippy little thing and be like, "This dude, stranger I saw on YouTube told me that I should do this." That should be the invitation.
Yep.
Hey, maybe you should give Alan a call.
That's right. That's
Maybe
right.
not try to DIY the advice. It's the opening to the conversation. It's the interest, like you said, it's the buffet where you're standing there trying to decide how you're gonna make up your plate. So, how do people get a hold of you? And I always ask everybody as we end the show.
Yeah.
I think most people checked out at this point. After we stopped talking about the nuts and bolts and the details, people skip over the mindset stuff. So if you're still here listening to how you aggregate all of this information into a cohesive plan and how to not feel overwhelmed, like this is the difference between people who are listening to sound bites on TikTok and people who are actually going to go out and do these plans. It's like the mindset part of it and the breathe in, breathe out. You can do this. So what kind of person should reach out to you after the show?
Yeah. Hey, listen, if you've gotten this far, we need to reach out. We need to talk, right? I
Yeah,
think there's a lot of things that we could help you out with. And the best way, so I'll say this, I think information is cheap. As a matter of fact, you go to
agree.
ChatGPT and find out a lot of really cool things right now. Information is cheap and it's getting cheaper. That's why I put everything that I know in this book right here. This is 15 years of financial planning right here, right? So what I would recommend is hey, if you've listened to this and you are getting ideas that you did not otherwise have, I think at this point you realize I think a little bit different than most financial advisors, right? And if your financial advisor is not bringing you these ideas or you don't have one and you just didn't know what was out there, right? I think that's the person that I would really like to have a conversation with. And the best way to do that, guys, our website, empowered-money.com, empowered-money.com. If you go there, you can actually schedule a meeting with me. More importantly, there's a free financial planning software there that takes about 10 minutes to do, where you can really see what you're on track to, how your assets are going to grow and what you're on track to do. Right. So looking forward a little bit on that hike that we're talking about.
Yep.
And sometimes that can be really inspiring there. To reach out to me, what's powered-money.com. I would love, of course, if you bought my book. I make $3 off of each copy, not a ton, right? But I would love it if you did and give me some feedback. But I would encourage you, check out, we have our podcasts on there. We've got some articles. We've got some really good content. But most importantly, do that little 10-minute financial plan. And that'll at least show you where you're at and where you're heading.
Yeah, awesome resources there. The information being cheap and it's getting cheaper is so true. It's like we want to be networking with people who are bringing integrity and transparency. Because, like you said, I can just go type in, what does Alan Franks teach at Empowered Money on ChatGPT and it'll summarize the whole thing. I feel like that is not enough to actually go out and build the real thing. So I appreciate you spending this much time with me today, this much time with our listeners and potential investors. I feel like this is something that I have been wanting to add to the show for so long because like this is something I can't really help our investors with legally, but to be able to give them the right resources conduct the parts and pieces and adding people into my network who can help in ways that I'm not able to help is exactly the point of the show. So I appreciate you spending that time.
Awesome. Hey, thanks so much, Emma, for having me. We spent like an hour and a half together. I feel like we could have done another hour and a half,
I
right? So
know.
hopefully you'll have me back here in the near future.
Yeah, definitely. There are some guests I always put like a little cue in the transcript. So I can be like, we're going to have you back next year. And I go search that because those are the ones that I really felt like the conversation was flowing. And I was like, okay, we got to cut it off. So yeah, definitely have you back in a couple of months next year and update on your life. I would love if we could even talk a little bit more, even about the personal stuff, like your own goals, your passive income
Wow.
journey, like where you're going. I think it's so interesting to hear people's stories and dreams and hearing ourselves in those, being able to identify with them and being able to say, you know what, Alan can do it, or Emma can do it. I can make this work. And that's really what we're here to do is give you a network that's empowering you as a listener to go out and take action. So if you want to get a hold of me, it's easy to do, partnerwithrise.com. If you want on my schedule specifically, partnerwithrise.com/Emma. And it's this neat little trick. then it works this way. You can do partnerwithrise.com/Chris or Zasha or Troy or Harmony, and you will find that person. So if you want to talk to any of my partners directly, we make it really easy for you to hook up with us because we all do different things inside the business and want to help you understand exactly who it is that you're investing with and meeting all of our partners and just developing that relationship so that we can help you by introducing you to great people. Alan is one of those. Be sure to reach out. I will see you next time. I want to hear your story about your next passive income adventure.